All right, welcome to the Explainer. Today we're decoding a really powerful technique that expert traders use to get a deep read on market momentum. And whether you're trading stocks or crypto, this is one of those advanced concepts that can seriously give you an edge.
Look, you've probably heard a million times about the classic 70-30 rule for RSI. Overbought, oversold, you know the drill. But what if there's a much smarter signal hiding in plain sight? A signal that doesn't just predict when a trend might end, but actually confirms that it's got some serious gas left in the tank to keep going.
Okay, so let's dive right into it. We're talking about something technical analyst Reuven calls reversal signals. Now, this is absolutely key, so listen up. Unlike a standard divergence, which you might use to predict a trend is about to turn around, these reversal signals do the opposite. They help you confirm that a powerful, existing trend is likely to continue.
So let's kick things off with the bearish side of the coin. It's called a negative reversal. This is a really potent signal that can pop up right in the middle of a downtrend, basically telling you, hey, the sellers aren't done yet. Now, take a look at this chart. What's so interesting here is that it seems like a total contradiction, right? If you look at the price action up top, you can see it's trying to push up, but it's failing to make a new high. But then you look down at the RSI for that same exact period, the RSI is actually pushing higher. And that little conflict, that's where the magic is. So how do you spot this? It's actually a super simple two-step process. First, you just find a peak in the price that is lower than the last peak. Easy enough. Step 2, you glance down at your RSI and confirm that at that exact moment, the RSI has made a higher peak than its last one. That's it.
And this is where you really get inside the psychology of the market. Think of it like this. The engine is screaming, it's revving louder and louder. That's your RSI making that higher high. But the car itself, it's losing speed. It can't even make it over the last hill. That's the price making a lower high. It's a perfect picture of sellers being in complete control, no matter how hard momentum tries to fight. All right, so let's flip that script completely and look at the bullish case, the positive reversal. This is the signal you want to see to confirm that an uptrend has the real strength to keep on climbing. And here on this chart, we see the exact opposite pattern. This is the kind of signal that tells a trader, hey, this asset might be pulling back a little, but it's really just catching its breath before the next major sprint upwards. And the setup here, well, it's a perfect mirror image of the bearish case, but we're looking at the bottoms, the lows. So first, you find a dip in the price that stops at a higher level than the previous dip. Then, you just confirm that at the same time, the RSI actually fell to a new lower low.
Man, this tells you such a powerful story about the battle between buyers and sellers. The sellers are throwing everything they've got at it, driving momentum, the RSI down to the mat. But the buyers are so strong that they just step in and say, nope, not today, and they stop the price from even falling to its last low. That is a huge sign of underlying strength.
Okay, but hold on. Before you go out and start seeing these patterns everywhere, the analyst adds a really critical filter. The amount of time that passes between the two peaks or the two troughs, it really, really matters.
Yeah, you can see it right here on the chart. See that one on the left, marked too wide? That's a weak signal. It's spread out over too much time, so you pretty much ignore it. But the one on the right, see how much tighter and more compact that formation is? That is the high-quality, reliable signal you should be looking for.
Okay, so let's put these two powerful ideas right next to each other. It'll really help lock in the difference in what the market is trying to tell us.
So the main thing to remember is this. The bearish signal is all about failing peaks in a downtrend. The bullish signal is all about super resilient lows in an uptrend. In one case, you've got sellers just steamrolling any attempt at momentum. In the other, you've got buyers holding the line so strongly that even a total collapse in momentum can't break the price.
All right, now this next part, this is a real pro-level insight. It's kind of a game changer, and it completely redefines how you should be looking at RSI when a market is in a strong uptrend.
So you know that rule about RSI hitting 30 meaning oversold? Well, in a strong bull market, you can just throw that right out the window. It's basically irrelevant. When buying pressure is this strong, momentum almost never gets that low. The real floor is much, much higher.
And this is the magic number, 45. According to Reuven, this is the new line in the sand for momentum in a bull market. You can think of it as the new zero.
So why is this so important? Well, think about it. When an asset is in a strong uptrend and the price pulls back, but its RSI comes down and bounces off that 45 level, that's not a red flag, it's a green one. According to this framework, that's often a sign that big players are accumulating, getting ready for the next move up.
It's a sign of health, not weakness. Okay, so let's wrap this all up. What's the new playbook? What are the key things you need to walk away with to apply to your own trading?
So to recap, you now have 2 advanced patterns to help confirm when a trend is likely to continue. You know to look for tight, compact signals and ignore the wide, lazy ones. And you've got a new critical RSI level, 45, to watch as your true support and potential entry point in a healthy bull market.
Look, this framework gives you a much deeper, more dynamic way to read the market story than just staring at overbought or oversold. It's about understanding the battle underneath the price action. So the real question I'll leave you with is this. Now that you know how to spot this hidden strength and weakness, how is that going to change the way you see momentum?